The money sitting in your bank account isn't truly real. This isn't a figure of speech, and it's not some wild theory. If every single account holder tried to withdraw their funds tomorrow, the banks would crumble almost instantly, because the cash simply doesn't exist in full. This isn't a flaw or an oversight. It's the intentional architecture of modern finance, a method so old, so deeply embedded, that society has normalized it. It's called fractional reserve banking, and it quietly drives debt, inflation, and the illusion of prosperity. Once you grasp it, you'll see money itself depends on promises that can never be fully honored. To trace how this system began, we need to step back to a time before digital banking and electronic transfers existed. In medieval Europe, wealth was measured in gold coins, silver, and jewels. If you had money, it often meant heavy bags of coins or treasure chests in your home. Carrying these valuables was risky, as thieves and bandits were ever present. To safeguard their wealth, people started leaving gold and silver with trusted goldsmiths artisans who had secure vaults. In return, the goldsmith issued a receipt, a written promise stating that the holder could return to collect their gold at any time. Soon, a new habit emerged. Instead of exchanging the actual gold, people began trading these receipts. The paper represented the same value as the coins themselves, but it was far easier and safer to transport. The clever goldsmiths noticed something important. Very few clients actually came to withdraw their gold at the same time. Out of 100 depositors, perhaps 1 or 2 would request their coins on any given day. The remainder of the gold remained untouched in the vaults, gathering dust. Seeing an opportunity, the goldsmiths began issuing more receipts than the physical gold they held. If they possessed 1,000 coins, they might issue 2,000 receipts. They could lend these extra receipts at interest, effectively creating money from nothing. As long as everyone did not demand their gold simultaneously, the system went unnoticed. This simple act of issuing more claims than the gold available laid the groundwork for fractional reserve banking, essentially conjuring money out of thin air. The implications were enormous. As soon as society accepted paper receipts as equivalent to gold, money creation was no longer tied to tangible assets. Banks eventually evolved from this practice, institutionalizing a model that allowed them to multiply wealth on paper. By the 17th century, governments recognized the potential. The Bank of England, founded in 1694, was not created to serve the public, but to solve a chronic problem. The crown faced overwhelming debt from endless wars. The bank lent more money than it actually held in reserves, with the promise of interest. The repayment came not from new treasure, but from taxes collected from ordinary citizens. The United States followed a similar path. Early American banks issued banknotes backed by gold, but soon discovered they could circulate more notes than actual reserves. Periodic bank runs exposed the illusion. Crowds of depositors demanding their cash, only to find the vaults empty. Entire banks collapsed overnight. Rather than abolishing the system, governments created central banks to stabilize the illusion. The underlying message was clear. Even when money does not exist, public belief in its value must be maintained. To understand how this works today, imagine depositing $100 into a modern bank. You might think your funds are safely stored. In reality, the bank is required to keep only a fraction, historically around 10%, in reserve. The remaining 90% is available for lending. Suppose someone borrows $90 to pay for groceries. The grocer deposits that money into another bank, which retains 10% and lends out the rest. This process repeats across the financial system. By the end, your original $100 can multiply into nearly $1,000 circulating in the economy. Yet, only the first $10 are actual cash. The rest exists as debt, an obligation to repay with interest. Even this classic model is outdated. In the United States, since March 2020, reserve requirements are effectively zero. Banks no longer need to hold a single dollar against deposits. The old multiplier does not constrain lending. So what prevents banks from creating unlimited money? The answer lies in capital and liquidity rules established under Basel, a global framework. Basel rules were introduced after a series of financial crises, especially after 2008, by central bankers and regulators meeting in Basel, Switzerland. At the Bank for International Settlements, often called the Central Bank of Central Banks, These rules, drafted by unelected technocrats, govern how much equity and liquid assets banks must maintain to absorb losses and survive short-term shocks. Banks must demonstrate they have enough shareholder equity to buffer risky loans. If a bank wants to make a higher-risk loan of $100, it may be required to hold $8 of its own capital as a safeguard. This system is the real leash on lending. The riskier the loan, the more capital the bank must maintain. Additionally, banks must hold liquid assets, such as cash or government bonds, to survive sudden demands. These regulations are designed to prevent reckless expansion while maintaining confidence in the financial system. Notice, however, the modern shift. Banks do not lend from existing deposits. They create loans first, which simultaneously create deposits in borrowers' accounts. A mortgage or personal loan doesn't involve pulling cash from a vault. It involves typing new money into existence. This newly created money exists only because the borrower agrees to repay it. Afterwards, banks check whether they hold sufficient capital to cover the risks. Today, over 90% of money in circulation is not physical currency issued by a central bank, but bank money, created as debt the moment a loan is made. When you see funds in your checking account, it is not the same as Federal Reserve notes. It is bank-created money, entirely dependent on debt. This system continuously expands as long as there are borrowers. Any financial crisis, therefore, is a crisis of confidence. When borrowers fail or banks cannot roll over obligations, the system begins to unravel. This structure produces three unavoidable outcomes. First, inflation. As banks continue multiplying the same initial dollars into loans and deposits, the value of each unit of currency gradually erodes. Prices rise not only due to supply and demand, but because the money itself becomes diluted. Second, perpetual debt. Every dollar that enters circulation is initially someone's obligation. Since interest must be repaid on top of principal, there is always more debt than actual money. This ensures that some participants must default, refinance, or borrow further. Third, concentration of power. Banks profit from money they never truly had, while governments exploit the system to fund wars, social programs, or bailouts without raising taxes directly. Meanwhile, ordinary citizens bear the cost. Wealthy individuals, holding assets such as real estate, stocks, and commodities, benefit as inflation drives prices higher. At the same time, workers find wages lose purchasing power, as the money in their accounts buys less each year. The system creates winners and losers by design, ensuring that those controlling capital continue to grow wealthier, while the majority remain indebted. History demonstrates the fragility of this framework. During the Great Depression in 1929, banks had extended credit far beyond their reserves, fueling an unsustainable stock market bubble. When fear struck, depositors rushed to withdraw their money, only to discover that the funds were not available. Thousands of banks collapsed, and millions lost savings overnight. The same pattern reappeared in 2008. Banks had packaged loans into mortgage-backed securities, multiplying credit far beyond tangible assets. Defaults spread quickly, threatening to destabilize the global financial system. Governments and central banks intervened, injecting trillions to preserve the illusion of stability. The trick was bailed out, because without it, modern economies could not function. Globally, the constraints on money creation differ, but the principle remains. In the U.S., traditional reserves are gone. In Europe, the United Kingdom, Canada, and Australia, reserve requirements had already become symbolic or entirely obsolete. Basel regulations now dictate how much risk banks can assume. In emerging economies, such as China, India, and Brazil, reserve requirements remain in place and are actively used to control lending growth. Yet Basel rules overlay these reserves, shaping the maximum risk banks may officially take. No matter where one lives, the real leash on money creation is not the deposits in vaults, but regulatory rules crafted far from public oversight. Here is the uncomfortable truth. The system cannot tolerate a society free of debt. If households repaid every loan tomorrow, the money supply would shrink sharply. Banks would have nothing to lend, economic activity would slow, and the illusion of endless credit would vanish. The entire system depends on your participation, your willingness to borrow, spend, and believe in the value of the numbers displayed in your account. You are both fuel for the economy and collateral in a system designed to maintain continuous lending. The mechanism is ancient, yet its risks are ever present. The goldsmiths of medieval Europe laid the blueprint, and today, that same method underpins global finance. Bank runs of the 19th century, the stock market collapse of 1929, and the 2008 financial crisis are echoes of the same fundamental principle. Confidence is everything. When confidence falters, the house of cards tumbles. Yet after each crisis, the response is consistent. Patch the illusion, reassure the public, and proceed as if stability is guaranteed. The lesson is clear. Money is not wealth. True wealth exists outside the digits on a screen, in land, tangible resources, skills, and knowledge. These assets retain value even when paper promises fail. Debt is no neutral instrument. It is the bloodstream of a system designed to favor lenders, governments, and asset holders, at the expense of ordinary participants. Inflation is not an accident. It is baked into the framework. Every year, citizens are asked to work harder, borrow more, and spend more just to maintain their position. The system rewards those with leverage and punishes those without it. Understanding this dynamic is not a call to fear, but a call to awareness. Recognizing that money is created through promises and that your financial freedom depends on stepping outside that cycle is the first step toward building lasting security. The cycle repeats itself endlessly, yet the consequences are tangible and personal. Their increases, no matter their form or location, trace back to the same fundamental truth. Confidence, not currency, holds the system together. Once that confidence wavers, the machinery of credit and debt can falter overnight. The more informed one becomes about the nature of money creation, the better prepared they are to navigate these fluctuations. Protect real assets and understand the forces shaping their economic reality. So what should you take from this? First, understand that money is not the same as wealth. True wealth is not numbers on a screen. It is tangible assets, land, resources, knowledge, skills, and independence. Things that hold value even when paper promises collapse. Second, recognize that debt is not neutral. It is the lifeblood of a system designed to favor lenders, governments, and those holding real assets, often at the expense of ordinary people. Third, realize that inflation is intentional. It is embedded into the system, design. Every year, you are expected to work harder, spend more, and borrow more just to maintain your position. Does this mean disaster is unavoidable? Not exactly. But it does mean you need to rethink your relationship with money. Leaving cash in a bank account offers no protection. Blind faith in the system will not free you. True financial security comes from building real wealth assets that survive outside cycles of debt and inflation. Awareness is the key, not paranoia. If your money exists as someone else's obligation, your freedom depends on stepping outside the machine. History doesn't repeat, but it rhymes. The goldsmiths of medieval Europe, the bank panics of the 19th century, the housing crisis of 2008 all echo the same principle. Promises often exceed reality, and belief keeps the system running. The story isn't over. Every major financial crisis reminds us that stability rests on confidence, and confidence is fragile. Next time you view your bank balance, remember, most of it exists only on paper, created by debt. Understand this, and you can protect yourself. Ignore it, and you'll remain a participant in a game where the house always wins. If this perspective changed the way you see money, hit subscribe. History has the answers, and I'll show you where to find them.